Morgan Stanley, the big investment bank, just lobbed a massive warning at the U.S. housing market in 2026. They just released a new research paper with some very interesting conclusions. And one of those conclusions is that we're going through an unprecedented housing market reset, unlike anything we've seen before in U.S. history. From a June 16th, 2026 research piece, they're asking the question, will housing become more affordable, or is the market resetting at a higher barrier to entry? And they're concluding that housing affordability is unlikely to return to the more favorable levels of the past, with many owners locked into low rates. And they're basically saying for home buyers that waiting for a return to pre-2022 affordability levels is the wrong approach. Instead, they're saying jump in now when the right opportunity arises for your circumstances. You have one of America's biggest investment banks essentially telling you guys to go out there and buy a house right now in today's market and warning you that it's not going to get cheaper. And the essential problem is the mortgage payment to income ratio across the US. You can see today it costs roughly 38% of household income in America to buy a house. While this is down a bit from the record levels of 2022 and 2023, you could see we're still more or less at one of the most expensive periods to buy in the last 40 years. However, I think Morgan Stanley is missing the mark on something in this research report. They're framing it as if home buyers have no leverage, as if home buyers have no other options, and as if home buyers are going to be the ones to capitulate. Instead of home buyers having to accept higher prices, I think we're just going to see home buyers stay on the sidelines for a very, very long time. As you can see that the housing market has now been in a 4-year depression in terms of home buyer demand, and a depression it is, everyone. You can see existing home sales from the National Association of Realtors have fallen to their lowest level, more or less on record, from 2022 to 2026. In the middle of 2026, we had 4.17 million annualized existing sales. That's basically at a 2008-2009 crash level. And so instead of asking the question, well, are home buyers just going to have to accept higher costs? I think the better question Morgan Stanley should have attempted to answer is, will home buyers ever come back to the U.S. housing market? Because the data that I'm looking at and the data I'm about to show you suggests that we could be on the doorstep of another 5 years of home buyers just being on the sidelines and not interested in buying. Quite literally, people cannot afford to qualify for these homes, and even if they can qualify for these homes, they choose not to because they don't want to be house poor. And there's something a little disconnected about a big investment bank like Morgan Stanley simply telling people to just buy the house anyway, because literally people who buy homes today are buying homes they cannot afford. Because you could see that the debt to income ratio for home buyers who are closing on mortgages as well as refinancing on mortgages in the US is now up to 40% according to Fannie Mae. And what the debt to income ratio shows is your total mortgage costs as well as your total debt costs divided by your gross income. And what's scary about this is the debt to income ratio today at 40%. It's actually higher than it was in the 2007 bubble when it peaked at 39%, which is alarming, everyone. Again, we're constantly told that we should just rush out and buy a house by big investment banks, by many realtors and mortgage brokers, by many real estate investors. Just basically a lot of people in the traditional real estate media say, oh yeah, buy a house now, don't worry about it. Well, look at the advice they're suggesting to people. Take on the most debt and leverage that you ever have in your life, that any home buyer has ever taken on in terms of U.S. history. They're saying that you should do that. And that is bad advice. If your debt to income ratio on the back end is 40%, that means you are going to be struggling to keep up with your mortgage payments. That means that you will feel house poor. And what's shocking is that the average buyer today is feeling house poor. It's like maybe you guys are thinking of buying this year or next year or a couple years in the future. What percentage of your gross income would you feel comfortable spending on that payment? Well, so far, about 2,300 votes into this poll, it's pretty interesting results. 36% of you think mortgage cost payment less than 20% of income is sensible. And this is mortgage taxes plus insurance plus maintenance divided by pre-tax income. Now, another 36% of you think 25% is a reasonable threshold. 72% of you think 25% or lower. Another 21% of you think 30%, and only 7% of you think it's sensible to buy a house with a payment ratio above 35% of income, which is what someone basically has to do if they were to buy today. It's going to be above 35%. The average is 40%. Now, the big investment bank, Morgan Stanley, is telling you, oh, maybe don't worry about those numbers. Don't worry about what you feel comfortable affording. Just buy anyway, is what they're saying, because in their mind, it's just not going to get cheaper. It's not going to get more affordable. And what I find really interesting about their analysis is it kind of like ignores previous housing cycles, because in the two most recent housing cycles before this one, the mid-2000s and the late 1980s, we saw a very similar situation to today. We saw home prices go up, and we saw the payment ratios at about the same levels as today. You can see back in the '06 bubble, we peaked at a 40% payment ratio. The annual payment back then was $19,000. The median income was $47,000. That was 40%. Back in the late '80s, it also peaked at 40%. Annual payment was $11,000. Annual income was $28,000. And what we saw in previous cycles was lots of improvement after that peak. You know, in the late 1980s, we had a peak in 1989. And then it improved all the way through 1999. It was a 10-year improvement in housing affordability. Home price growth actually went negative in the early 90s on a national basis, and then basically was flat for like 4 or 5 years. Incomes caught up, rates went down. It was pretty affordable to buy a house by the late 90s. Then from '03 to '06, we had that bubble. In the mid-2000s, it got really expensive. Demand dropped. And then from '06 all the way to about 2016, we saw an improvement in affordability down to a 25% ratio, mortgage cost to income. And so it's curious to me how someone could just ignore this history, right? It's very clear we have these peaks and valleys in affordability, and we were already starting on the path to more affordability in the market. Now, the one reason why I think Morgan Stanley missed this is they made an assumption in their analysis. They made an assumption, and their assumption was this: when rates stabilize and home price growth slows, affordability metrics should improve. Their base case suggests that mortgage rates will moderate closer to 5% over the long term. However, they feel that affordability gains are expected to stall in 2027 as longer-term forces reassert themselves, including a trend towards higher rates across the economy and continued population growth among first-time buyer demographics. So they don't actually end up seeing much improvement in affordability because they think, well, maybe mortgage rates will drop a little bit, and they only are assuming slowing home price growth. They're not assuming that home prices go negative. And basically, if you say, well, mortgage rates aren't really going to get below the high fives, and if you say home prices won't go negative, well, then yeah, it's going to be hard for affordability to come back into the market, because then the only thing that's going to improve affordability is income growth. The only thing that's going to get our home price to income ratio in the US back to a more reasonable level is higher median incomes. Today, the median income in the US is $85,000. To get that mortgage cost to income below 30%, we would need $110,000 median income, which would be about a 28% growth in median income. That's going to take 6 or 7 years, most likely. And so I think that's where Morgan Stanley is getting this whole idea that we're just not going to see an improvement in affordability, is that they're really just going to base it off higher incomes, and that's going to take time. But I think it'd be foolish to ignore the prospect of home price declines, because home prices are already dropping in close to half the US. In markets like Austin, they're already down 25%. In many markets in Florida, they're down double digits. And now in areas like Colorado, Arizona, Washington, Georgia, prices are also going negative. And so we have evidence that this is possible. I show you listings on this channel every day, pretty much, of sellers taking huge losses. And fundamentally, we need prices to drop. The only way this market will ever return to normal is if prices drop. I want you all to pay attention to this 130-year graph comparing home prices to mortgage rates in the US. This data goes back to 1890. It sourced from Robert Shiller, the Federal Reserve, as well as a great research paper from the 1950s, Capital Formation on Residential Real Estate. And the first thing that jumps out about this graph is the fact that it's actually home prices that are the problem in today's market. It's home prices that are driving the inflated mortgage costs. It's high mortgage balances. It's high down payments. It's the high prices that people are paying. We've never seen prices this high. And you can see that the inflation-adjusted home price in the U.S. today is close to about 80 to 90% above the long-term 130-year average. And so when housing feels expensive, it's due to the high prices. Now, the mortgage rates certainly have shot up over the last 5 years. However, a 6.3% mortgage rate, which is what the average has been for 2026, that's pretty close actually to the long-term norm. The long-term average mortgage rate the last 130 years is 5.6%. And so, yeah, mortgage rates are only a little higher than normal. Home prices are way higher than normal. That's the fundamental issue, is these sky-high prices. And so any discussion of home buyer demand, any discussion of housing affordability that doesn't talk about this massive home price bubble is ultimately disingenuous and not talking about the real fundamental issue. People wonder, why are people not buying homes? Well, it turns out it's actually a way better deal to rent than it is to buy, like substantially so in most markets. So if the alternative is buy a house, spend 40% of your gross income on the costs, or rent a house in the same neighborhood, like an identical house almost, and spend 27% of your gross income on the rental, and also get to maybe invest your down payment in the stock market or something else, yeah, a lot of people are choosing to rent. With CNBC recently running an article asking, is buying a home still the American dream? Some renters are now happier without the hassle. In this article, they talk about how renting is now cheaper than owning in every large metro in the country. You can see on this chart from the CNBC article, they compare a survey from 2013 to 2024 for reasons why Americans rent instead of buy. You can see back in 2013, only 23% of people rented because it was cheaper. Now 46% of people rent because it's cheaper. However, the biggest increase is convenience. Back then, 24% of people said it was more convenient to rent. Now 58% of people say it's more convenient to rent. With a lot of people now asking the question, is it actually a value of mine to own a property? Why would I spend more to own a worse place in a worse neighborhood that requires me going to the worst place on earth, Home Depot, every Saturday? Who says renting in both New York City and LA is a better financial and lifestyle decision for his family than buying? So could it be that people are just simply not interested in buying houses? You know, I've been wondering this over the last year or two. I mean, I kind of expected by now that maybe some of the demand would have come back a little bit, but it's not. And this just might be a structural change that these research pieces from companies like Morgan Stanley are missing. They're operating under some assumption that there's all these first-time home buyers chomping at the bit to buy a home, and that there's all these empty nesters chomping at the bit to buy a home. But what I'm seeing is that there's a lot of people who are really comfortable not buying a home, and that the financial realities of buying versus renting say it's better to rent, and that the people who are buying are taking on massive debt burdens, the highest debt burdens that we've ever seen in terms of debt to income. And we're seeing many of those people regret it. So maybe home buyers are just going to be out on the market for an extended period. And another thing we need to consider is demographics. Demographically speaking, America is going in the wrong direction for the housing market. You could see this green line. The birth rate in the US, births divided by population, is plummeting over the last 35 years. We're now essentially only having 1% growth per year from births on our population. But at the same time, this red line, the death rate, is increasing. The death rate is now up to 0.91%. That we could see these two lines cross, and that maybe by like 2034, more people in America will be dying than being born, which will have massive housing market implications. That's going to mean more estate sales. That's going to mean more baby boomers leaving their homes and putting them up for sale. And that's going to mean fewer young families desperate to buy a home. And again, if someone's going to perform any type of serious analysis on the state of the housing market and where it's going, how do you not include the demographic trends? And so when I look at listings like this on the housing market, with houses that were so much cheaper 6 to 7 years ago, and they're just now sitting on the market. You know, I say to myself, do these sellers like really understand where things are heading? This owner bought for $200,000 in 2017 and has now listed their property for $370,000 in 2026 after trying to rent it out over the last couple years and actually having to cut the rent. So I want you to look at this, folks. This owner is cutting the rent from $2,500 to $2,100, taking it off the market for rent and now trying to sell it at an 85% premium. You can see this house is a pretty standard issue. Looks like it hasn't really been renovated in a while. That kitchen looks to be at least a decade or two old. I mean, how are you asking for 85% more than you bought it for a house like this? Granted, it does look like it has a nice yard. It has a little land. I was actually curious how much maybe you should offer on a house like this. So I actually ran it through our listing tool analyzer here at Reventure app to see kind of what the fair offer range would be. We're getting $290 to $316. So that's about 10 to 17% less than the current list price. So we're actually giving them the benefit of the doubt. The only way to really transact in this market is to try to find a house at a big discount. This is something I did 3 or 4 months ago. This is something that's happening a lot across the US. While the overall market's still expensive, there are many sellers out there who are getting a bit desperate, sellers who bought at the peak at a higher mortgage rate, whose house has been sitting. You can actually find some really big discounts on houses if you know the cities, zip codes, and listings to target. And what we do on this listing tool, which you can use for almost any listing in the US housing market, if you go to www.reventure.app/listing tool and sign up for our premium account, only $39 a month, you can use this listing tool in unlimited fashion to search the listings in your market and get an idea of how much you should offer. On this one, we looked at the trends and how much the zip code has gone up since they bought in 2017 versus the property. And actually, this owner is increasing it at 75%, which is more or less the same as the overall zip code appreciation. So the zip code has legitimately gone up a lot. The owner is pricing at $276 a foot, which is a bit higher than the comps at $271 a foot. However, the big thing to pay attention to in this area is our forecast. We're forecasting prices are going to drop 8% in the next 12 months. So when we apply that forecast to these valuations, folks, we're getting a $290 to $316 offer range. If you are someone who is interested in buying a house right now before the end of 2026, go to www.reventure.app/listing tool and upgrade today so you don't get caught overpaying for a house in a market that's still in a massive bubble. Now is the time to make offers, but check the data for your area.